Compound interest is a really important part of saving. The magic of compounding helps your money grow even when you're not adding money to your account. And who doesn't want to earn gains on their gains? But what is compound interest and how does it work? In a nutshell, when you save and earn interest, compounding is when you start to earn interest on that interest. So, whenever the interest is added to your account, which could be daily, monthly, quarterly, or annually, it has the potential to create its own returns. So, let's take an example. Say you stick £1,000 in an account that pays 4.5%. The interest you earn is then added to your account at the end of a year. After that first year, you'd earn £45 in interest, so you'd have £1,045 in total. So far, so simple. Then, with the interest added to your savings the following year, assuming you get the same rate, you'd earn 4.5% on the new balance of £1,045. On this new balance, you'd then earn £47, so more than the first year, giving you a total of around £1,092. If you keep adding the interest to your savings, you'll keep earning the interest on the interest. And the longer you save, the more you'll benefit from compounding. If you're more of a visual person, there's a popular analogy that helps explain compounding. So imagine a snowball rolling down a hill. It starts off small, and as it picks up more snow, it grows bigger in size, as does your money when it compounds. When you look at the rates of any savings or current account, you'll often see two different ones advertised, and that's because of compounding. So, gross is the amount added to your balance, while AER, which stands for annual equivalent rate, is what you'd earn when compounding is factored in over 12 months. Sometimes these two rates will be the same. So if you had that £1,000 in the account paying 4.5% gross, at the end of the year, you'd earn £45 in interest, giving you £1,045 in total. So the AER is the same at 4.5%. But if the interest is paid more than once a year, so that could be monthly or quarterly, for example, it can keep compounding. And that means the AER will be higher than the gross rate. So if you were paid interest monthly, that 4.5% gross interest payment each month would be earning interest too. And as a result, the AER would actually be closer to 4.59%, earning you £45.90 over the year. If it was paid daily, then there would be more opportunities for it to compound. So the AER on that account would be 4.6%. Not a huge difference to the monthly interest payment, but it shows how it works. That's why when you're comparing savings rates, you always want to look at the AER rather than the gross rate. Most savings will compound your interest, but there are some exceptions. So watch out for accounts that pay away interest. This is usually with longer term fixed bonds. These require you to have a nominated account where the interest is moved into rather than added to your balance, which means you won't benefit from compounding. However, that's not necessarily a bad thing. So, if you're fixed for a long time and are worried about the interest you earn over a number of years taking you over your tax free personal savings allowance, paying the interest away each year rather than getting it at the end of the term could help you keep within your allowance or reduce the amount of tax you pay. You might also not benefit from compounding if you opt for an account that only lasts for a short time at the advertised rate. So once the term is ended, all the money could then be moved to a different and lower paying account. So though the interest might compound throughout the year on a 1 year fix, there's a good chance the whole balance won't earn anything after that. Another thing to be mindful of is accounts that don't pay interest above a set balance. So when interest is added, it earns nothing at all unless you move it elsewhere. For example, the Santander Edge Saver pays 6% AER on savings up to £4,000, and the Barclays Blue Rewards Rainy Day Saver pays 5.12% AER up to £5,000. In these cases, the amount you can earn in interest will also be restricted. Let's take the Santander Edge Saver as an example. So any balances above £4,000 earn no interest. That's not a problem for lower amounts. So if you put in, say, £3,000, the interest will compound and you'd earn about £180 in a year, which reflects that headline 6% AER rate. But if you put in the full £4,000, it's impossible to compound each month. You'd actually earn around £233 over a year, which is the lower 5.84% gross interest rate, as the interest can't compound. Of course, if you move these monthly interest payments each month to another account paying interest, they will have the opportunity to compound, but you do need to move them. Now, with all this in mind, should you get your interest paid daily, monthly, or annually? Now, this is a question we get asked often, and it's a really good one. So, most banks will pay interest each month or each year, and in some cases, as with Trading 212, you'll get it added to your account daily. If you look at the AER, it shows you what you'll earn after a year, including any compounding, so it won't make a difference when you are paid the interest. If you're comparing the gross rate, daily compounding can give you a slight edge over monthly, but the difference is really small. But both these options will pay a bit more than if you go for annual interest. So, say you had £5,000 saved for a year in an account paying a gross rate of 4.5%, you'd get £229.70 with monthly interest. This is provided you keep the interest in the account and don't make any withdrawals. Daily compounding would give you £230.12, so not much difference there. And if the interest is paid annually, you'd earn a slightly lower sum of £225. Then, if we look at over 2 years, you'd earn about £470 with monthly interest and around £460 if you got the interest paid annually. While there's not much difference in how much you can earn with these examples, some people also prefer monthly interest payments because they like having the regular income. But you may find accounts that pay annual interest have more competitive gross rates than those that pay interest monthly. If you can find the same rate of interest for monthly payments as annual, then go for it. Although, as we've seen, the difference will be marginal. But in reality, it's the AER that you want to be comparing. Another question I've seen is whether you can earn compound interest on a cash ISA. The answer is yes, you can. And with ISAs, you don't need to worry about exceeding your personal savings allowance because the earnings are all tax free. Now, you might be wondering how you work out compound interest. Well, pretty much every account you see will list the AER, so you don't need to. But if you're curious and a bit of a maths head, you can use this lovely simple equation: A equals P bracket 1 plus R slash N close bracket NT. Make sure you use the formula on the screen. So that's A equals final amount, P equals initial principal balance, R equals interest rate, N equals number of times interest is applied per time period, and T equals number of time periods elapsed. And if equations aren't for you, you can use an online calculator like the one on the calculator site to work out how much you could earn on your savings with compounding. Or there's also an AER calculator from Optimally, which helps you compare savings accounts that have different terms. And that's it. Thanks so much for watching. Check out these videos here for more ways to make the most of your money.